Assalamualaikum, hi class. So today we continue with the same topic 6, but this will be on the real property company, RPC and tax administration. So again, for the learning outcome, at the end of this topic, you will be able to compute the RPGT for disposal of shares of real property company and also the tax administration on the real property gains tax. So what is real property company, RPC? It is a controlled company, which is a company having less than 50 shareholders and is controlled by less than 5 members, which owns real property such as house, land and so on, or RPC shares, or can be both of them, real property and RPC shares, where the defined value of such asset must be at least 75% of the value of the company's total tangible assets, or TTA. So defined value here is the market value of real property and or, which means if you have only real property, then you will take market value of real property. If you have both, you will take market value of real properties and the acquisition price of shares in other RPC. While total tangible assets is the aggregate of defined value of real property or shares or both and the value of other tangible assets. So what is other tangible assets? They are the rest, the remaining assets other than real property and RPC shares. For example, plant and machinery, bank and cash, prepayments, investment in shares in non-RPC company. So they are other tangible assets. You must aware that we are focusing on other tangible assets. It shouldn't include intangible assets or even liability. So the computation is, a company would be termed as RPC if the defined value of the real properties and also the RPC shares over the total tangible assets at least 75%. So which means how to compute DV over TTA times 100%, your percentage must be at least 75%. Then the company will be status as RPC. If less than 75%, then the company is not RPC. So next, Schedule 34A sub 1 is regarding acquisition of shares in RPC. The schedule say, acquisition of shares in RPC is deemed to be an acquisition of chargeable assets. Therefore, the disposal of such shares is deemed to be a disposal of chargeable assets, notwithstanding that at the time of disposal of such shares, the relevant company is not regarded as RPC anymore. So these apply to existing shareholders upon disposal of its shares. So which means, let's say currently the company is not RPC. So they have, the existing shareholders holding their own shares in that company. So currently that shares is not RPC shares. But after certain period, when the company has real property and also investment in other RPC, so they calculate the defined value of the real property plus the AP of the RPC shares over the total tangible assets and satisfy the 75% requirement. So the shares, the existing shares in that company will actually automatically become chargeable asset. So the disposal of shares later in future would be deemed to be disposal of chargeable asset, irrespective of whether at that time the company is no longer RPC. So that's the reason they say it applies to existing shareholders. So I will actually explain further about this. So next, for the date of acquisition of shares in RPC according to paragraph 34A sub 2 schedule 2. So the date of acquisition of a chargeable asset is either situation 1, the date when RPC shares are acquired, or situation 2, the date when the company become RPC. If it is not RPC, when the shares are acquired. So this is known as deemed date of acquisition. So situation 2 is the one that is like the example I explained just now. Currently, the company is not yet RPC, and after certain period, Okay, when the company has the real property and investment in RPC shares, it meets the 75% requirement. The existing shares in that company would be deemed a chargeable asset. So they are deemed to be acquired at the date the company become RPC. So they will apply the deemed DOA, which is situation 2. But if let's say currently the company is already RPC, so the date when RPC shares are acquired, we will apply the situation 1. So acquisition price of shares, if the shares acquired when the company already become RPC, which is situation 1, the AP of the RPC shares would be the consideration paid for the RPC shares as determined in the sales and purchase agreement of the shares. So this is as per the consideration agreed between two parties. However, in the event when the company is not RPC at the time of the shares acquisition, so the AP of shares would be calculated based on the formula as per paragraph 34A sub 3, which is A per B times C. So what is A per B times C? A is the number of shares acquired in RPC, which is deemed to be a chargeable asset. B is total number of issued shares in the relevant company at the date the company become RPC. Why we need to differentiate? Because A is when the company is based on the existing shareholding. While B is, let's say after certain period, there is actually an increase or decrease in shareholdings. So you must know what is the current total number of issued shares in the relevant company until the date the company become RPC. And C is the defined value of real property and all shares in another RPC. So we can also look into the formula like this. A per B is a percentage of control owned by each individual shareholders, while C is the defined value, which is market value of real properties, and or the acquisition price of RPC shares, in other RPC shares. So this formula A per B times C is used only once at the time the company turns into RPC. Once the company become RPC, the acquisition price of shares will be based on situation 1, which is as per the consideration agreed between two parties. So next we look into disposal price of shares according to paragraph 34 sub A, sub 4 of schedule 2. So paragraph 5, schedule 2, which is as per the basic formula that we have learned before. If you still remember, disposal price is consideration received minus enhancements costs or permitted expenses minus legal fees to defend the land title minus incidental cost of disposal. So that formula will not apply in the case of disposal of RPC shares. So what will be the disposal price of shares? Under this paragraph, they say the DP will be amount of value of consideration in money or money's worth for disposal of the chargeable asset. So it means that disposal price is as per the agreed value between the two parties. What will be the amount that the seller receive from the buyer? So that is the disposal price. So next, disposal of shares in RPC. Section 7 sub 1 sub A will still applicable, which is if the disposal price is more than acquisition price, then you will get a chargeable gain. However, if let's say the disposal price is less than acquisition price, the loss suffered before this it is known as allowable loss. But in the case of disposal of shares, when DP is less than EP, the loss suffered upon the disposal of shares in RPC will not be treated as allowable loss, but it will be treated as permanent loss because no relief is available on such loss. So meaning that loss will not be able to reduce or set off any chargeable gains of the companies in respect of disposal of other properties. So next, para 3B shares. So actually this B is the small b, it's not the capital B. transfer of real properties to a controlled company, and satisfy condition para 3B Schedule 2. So the shares would be deemed chargeable asset and known as para 3B shares. Therefore, disposal of such shares will also subject to RPGT, but as per paragraph 3B. So, the shares would not be treated as RPC shares even though the company turns into RPC or is RPC at the time of the transaction, which means para 3B will prevail or will take priority over the RPC status. Okay, so we look into cessation of RPC. Once a company becomes RPC, subsequent acquisition of real properties has no impact on the RPC status. However, the status of RPC may be changed upon disposal of any real properties in that company, which means if the company keep on purchasing a new assets or real properties or RPC shares, it will not affect the company status as RPC. But if the company dispose the real properties, then it will affect the status of RPC because it will affect the amount of the DV. Okay, so that's the reason assessment of DV over TTA to meet the 75% requirement must be done on every disposal. If during the assessment it doesn't meet the requirement of 75%, the company will be no longer become RPC. And so what is the implication to existing and the new shareholders upon cessation of RPC? For the existing shareholders holding RPC shares would continue liable for RPGT despite of the change of company status because their shares are deemed acquired. The acquisition of the shares for the existing shareholders are known as acquisition of chargeable asset. So when they dispose that asset, that disposal shall subject to RPGT. That's why they say they will continue liable for RPGT. We will not look into the status upon disposal. However, for new shareholders, the shareholders acquiring the shares when the company is no longer RPC, is said to be acquiring a non-RPC shares. Therefore, the shares is not chargeable asset, and the disposal of such shares in future will not subject to RPGT.